Welcome to Finance Zoom channel. As 2023 unfolds, economic concerns have taken center stage in discussions worldwide. The Federal Reserve's recession outlook has captured significant attention, projecting an optimistic recovery. However, many experts and economists argue that the Fed might overlook a critical threat: inflation.
Forecasting a recession.
Absolutely, Liz. We didn't think there was going to be a recession at any time over the last 18 months.
In today's video, I will delve into why the Fed's recession outlook could be misguided and why inflation is poised to exacerbate further in 2023. Join me as we explore the implications of these economic factors and their potential impact on the global financial landscape. The concerns surrounding the Federal Reserve's recession outlook. The Federal Reserve's predictions about the occurrence of a recession are incorrect, and instead, the situation will worsen due to rising inflation. The Federal Reserve's assessment of the economic conditions and their potential impact on inflation is misguided, and the actual outcome will be a worsening of inflationary pressures rather than an economic recovery. It indicates a critical concern about the possibility of escalating inflation and its adverse effects on the economy. According to a CNBC article, economists have differing views regarding the implications of the recent low consumer price index and producer price index numbers. While some believe it indicates a potential soft landing and victory over inflation for the economy, others still fear a looming recession. The Federal Reserve may hike interest rates again in late July, continuing its cautious approach.
I don't know why, Andy, you see it as dovish. Let our viewers decide. Here's how he put it.
The worst outcome for everyone, of course, would be not to deal with inflation now, not get it done. Whatever the short-term social costs of getting inflation under control, the longer-term social costs of failing to do so are greater, and that the historical record is very, very clear on that. If you go through a period where inflation expectations are not anchored, inflation is volatile, it interferes with people's lives and with economic activity. And
Chair Powell strongly emphasizes the critical importance of promptly addressing inflation. He firmly believes that failing to take action now could lead to severe consequences for everyone involved. While he acknowledges that short-term social costs might be associated with controlling inflation, he argues that the long-term social costs of not doing so would be even more significant. According to Chair Powell, historical evidence strongly supports that allowing inflation to remain unchecked can have detrimental outcomes. Unanchored and volatile inflation expectations can disrupt people's lives and economic activities. Thus, he stresses the need to prevent such a situation and emphasizes the necessity of decisive action. Chair Powell did not want to repeat the situation in 1981, when the Fed kept raising rates, leading to a recession. However, he also doesn't want the Fed to quit too early in its efforts to address inflation. Regarding the current state of the economy, Peter believes that rates are too high compared to the economic trajectory. He predicts that the Fed will likely lower rates sometime next year, though the extent of the cut is uncertain. He doesn't foresee rate cuts before the current year's end. Powell points out that the Fed funds rate has increased significantly over the past year, indicating that rates are now too high for the current economic conditions. He predicts that the Treasury may face challenges in paying over $1 trillion of interest in the future due to the elevated rates.
Again, that's kind of the way I see things as well.
Peter.
I'm sure Peter disagrees.
Well, I think the most significant admission that Powell made was that the Fed's going to start cutting rates long before inflation gets back down to 2%. And in fact, I think the Fed might start cutting rates even as the CPI is trending back higher. Because remember, the main reason...
He said no cuts this year, I think.
Right,
That's what he said.
Right, but he said the Fed's going to start cutting before inflation gets down to 2%.
One thing that caught Peter Schiff's attention was Powell's admission that the Federal Reserve plans to start cutting rates long before inflation goes back to 2%. This is a significant move that could have far-reaching effects on the economy. According to Powell, even as the Consumer Price Index, CPI, starts trending higher, the Fed might still consider rate cuts. This is a departure from their previous stance and suggests they proactively address economic challenges. Remember how the drop in oil prices caused the headline CPI to go from 9% to 3%. In the last 3 months, oil prices have risen by 25%, and this upward trend might continue, pushing oil prices to new highs. As a result, we could see increased upward pressure on headline CPI before the year ends, potentially negatively impacting the economy.
So I think the Fed is wrong on its recession outlook. We're going to have a recession. In fact, it's going to be a severe one, but inflation is going to get worse.
Peter Schiff was concerned about rising interest rates and the national debt. Seeing how much our debt has grown in just 22 years is mind-boggling. Back then, when interest rates were at 5.5%, the national debt was $5.6 trillion. But now, it's a hopping $32 trillion. Can you believe it? And with these high interest rates, you could be looking at paying $1.8 trillion in interest on the debt. That's more than twice the budget for national defense.
One debt to society later.
He believes that cutting rates won't fix our problems. It could worsen inflation. And if inflation keeps rising, it will hit us, the middle class, and the working poor hard. Considering the challenging economic situation, there is also a question of whether the Fed's decision to pause rate changes last month was the right thing to do or a mistake. Well, the best thing to do is to stay informed about all of this and understand how these decisions affect our lives. Let's watch the economy closely and be prepared for whatever comes our way. Now let's have Fed's rosy recession outlook. The Federal Reserve's economic forecasts are crucial for market sentiment and policy decisions. They express confidence in the recovery, citing factors like vaccination rates, consumer spending, and job market revival. However, one element appears to be underestimated: inflation. In 2022, the global economy experienced a surge in inflation, impacting various sectors and causing significant price hikes. Unfortunately, these inflationary pressures will persist in 2023 due to increased money supply, stimulus packages, and supply chain disruptions. Consequently, consumers may face higher prices for goods and services, resulting in reduced purchasing power and a potential hindrance to economic growth. Additionally, the labor market struggles with shortages, leading to increased wages and operational costs, further fueling inflation. Government policies, especially those from the Federal Reserve, will play a crucial role in shaping the economic outlook for 2023, with a need for a careful balance between curbing inflation and supporting growth to avoid long-term economic consequences.
Not move rates at all. In retrospect, was that a mistake or the right thing to do?
Well, there were a lot of economic numbers that were to the strong side. However, the unemployment number and the inflation number were not two of those. So in retrospect, I'd say it was a jump ball or a close call. Paul is fighting a bunch of doves on the committee, and now with Bullard gone, it's going to be less hawks. So he's got to kind of squeeze a line in there. One thing I do want to say, Peter, I agree with everything. I don't agree with everything, but nonetheless, it's not the Fed. It's the U.S. government that has come to market with too many stimulus programs that have really increased the debt.
Andy Brenner believes that while some economic numbers were strong, the unemployment and inflation figures were unfavorable. He sees the situation as a close call due to differing views on the Federal Reserve Committee. He agrees with some of Peter's points and puts the spotlight on the U.S. government's stimulus programs, which have led to a massive increase in debt. And guess what? The Federal Reserve's actions played a role in enabling this reckless spending. But here's the scary part. We're sitting on a ticking time bomb of debt, which could explode at any moment. Andy's sounding the alarm for more fiscal responsibility before it's too late. Buckle up, folks, and stay tuned for the latest economic updates. As I wrap up my discussion on the Federal Reserve's recession outlook and the looming threat of inflation, it's clear that there's more to the economic landscape than meets the eye. While optimism is in the air, you must not overlook the growing concerns about inflation, and its potential impact on your finances and daily lives. So what are the investment options in these uncertain times? T-bills might seem attractive with their 5.5% coupon, but Andy and Peter have different views. While Andy finds safety in T-bills, Peter sees inflation as a real risk, advocating for investments in real money like gold and inflation-sensitive sectors like agriculture and energy. As you navigate through 2023, we must be vigilant about the economic developments around you. Balancing risk and potential rewards will be crucial in investment decisions, especially during surging inflation. So stay informed, keep an eye on the market, and consider diversifying your investments wisely to adapt to this dynamic economic landscape. If you found this video informative, don't forget to subscribe to my channel. By staying proactive and well-informed, you can protect your financial interests and strive for a stable and prosperous future. Thank you for joining me in this insightful discussion, and I will see you next time for more economic insights and updates.